APAC's asset and wealth management industry recently saw further evidence that APAC's next-gen investors are more likely to change their wealth managers. Singapore's private banks look to recruit their up-and-coming high-net-worth individual clients. Hong Kong passed legislation to establish a stablecoin regulatory regime and framework, and China start to aggressively tax overseas investments. Let's take a deeper look at these, as well as other headlines and developments. Over to Singapore. Singapore's major banks are running bootcamps for the offspring of wealthy potential clientele, largely from mainland China, as they attempt to tap into rising wealth even amidst increasing scrutiny and due diligence. The sessions, potentially run across several days, aim to impart some lessons on money management and serve as a forum for attendees to network with peers. They reportedly usually involve less than 50 participants between 20 to 50 years of age, and also serve as a launching point for the banks to win their business or that of the attendee's family. Attendees come from the upper echelon of banking clientele, with participants from the top 10% and top 20% of UOB and Bank of Singapore's clients respectively. UOB, which reportedly missed a 2024 intake in order to plan a longer program, will be running its second overseas program later in 2025, with McKinsey, a global management consulting firm, estimating a $5.8 trillion wealth transfer between 2023 and 2030, laying the groundwork for capturing some of this transition can be very lucrative, especially as both the amount and proportion of wealth management fee income has been increasing for Singapore's top 3 local banks. For first quarter 25, UOB and DBS reported a year-on-year increase of 30% or more in wealth management fees collected, while OCBC saw an 18% boost. At DBS, wealth management accounted for 48% of its fee income over the same period, up 6 percentage points from the same period in 2024. McKinsey also estimates that transfers from mainland China to Singapore reached $400 billion at the end of 2023, the highest across all APAC sources for the city-state. Foreign banks such as HSBC, Standard Chartered, and Citigroup also have next-generation initiatives in place. Those Singaporean private banks are seen as more exclusive in terms of whom they admit to their program. HSBC, a British financial institution with historical ties to Hong Kong and China, has launched a similar scheme in Hong Kong, which targets entrepreneurs who are yet to join the ranks of their private banking clientele. The program offers things such as tailored wealth planning, investment events, and access to a global network of industry experts. HSBC also notes that 2/3 of their private banking clients were entrepreneurs, so creating a potential pipeline for this significant client segment seems to be a sound decision. Whether such schemes bear fruit amidst a great wealth transfer remains to be seen. Up next, a report on Islamic finance from Standard Chartered, a British bank, has identified Singapore as a potential top market for Islamic banking, behind established centres like Dubai, Malaysia, and London. With the low cost of fund distribution, favourable sovereign rating, and strong investor base cited as making it a promising Islamic financing centre in a growing industry. As per the report, Islamic finance boasted $5.5 trillion in estimated assets in 2024, which was expected to increase to $7.5 trillion by 2028, largely driven by Islamic banking. China was seen as a key economic corridor, and green sukuk and financing were the most important product innovations seen by Islamic banks, so Singapore may be able to position itself accordingly. Further, following the announcement of its intention to attract $200 billion in net new money over the next 5 years, especially in the key markets of Hong Kong, Singapore, the UAE, China, and India, Standard Chartered has launched its Beyond credit card in collaboration with MasterCard, yet another credit card launched in Singapore targeted at either the mass affluent, high net worth, or ultra high net worth client segments. While this card is not invite only, to be eligible, applicants must have annual income of at least 200,000 Singapore dollars, generally those in Standard Chartered's priority banking or priority private clientele. The card offers the usual array of points and perks like access to premium golf clubs, airport lounges, and flight upgrades. According to the bank, Over the first 3 quarters of 2024, income from the affluent business accounted for 68% in the wealth and retail banking business, and this is expected to reach 75% by 2029. With numerous credit cards targeted at the ultra high net worth and high net worth individual segments, and a rising mass affluent class across APAC, banks' less well-heeled clients may be in for some neat perks. Moving on. Following the release of the first set of measures to strengthen the competitiveness of Singapore's equity markets by the Equities Market Review Group in February 2025, the MAS, Singapore's financial regulator, and central bank released a consultation paper on the proposed amendments to garner feedback on the proposals to streamline prospectus disclosures and facilitate the profiling of offers. The proposals focus on the following main areas, suggesting that primary listing offers refocus on core disclosure requirements so that there is a clear disclosure on the most relevant and material information to investors. This would be accomplished by driving more targeted and meaningful disclosures and ensuring that time and costs needed to compile the requisite information are commensurate with the informational value to investors. For secondary listing offers, aligning disclosure requirements with baseline international standards outlined by IOSCO. These standards are already present in many markets, including Singapore. Broadening investor outreach channels for IPOs through increased flexibility and scope to engage potential investors earlier on in the IPO process. This would be accomplished through allowing issuers to disseminate the preliminary prospectuses and present oral or written materials contained within to retail investors, providing more flexibility for issuers to engage institutional investors and accredited investors by allowing issuers to present oral or written material pertaining to the IPO at any time prior to the lodgement of the preliminary prospectus, and expanding the scope of information that issuers can provide by including things like anticipated timing and manner and purpose of the intended offer, such as via banking portals. What results from this push to bolster Singapore's capital markets and any flow-on effects to the wider asset and wealth management industry will be interesting to see unfold. So, that is this episode's section on Singapore. Check out the links in our profile for this episode's other sections, and do comment if there was something that you think should have been included which was missed. Many thanks for watching. Hope to see you next time.